Well, hello, everybody. Steven Sitkowski here. Welcome to this week's edition of Market Insights. Take a look at what's going on in the financial markets. It's tax day, April 15th. Always fun. I know I graced the IRS with my quarterly. I feel like I could keep a small third world nation running. Anyway. I want you to know that everything we do here is for educational and informational purposes only. It is not intended as investment advice. So, what do we want to keep an eye on this week? Well, today we got a little bit of Fed speak coming out. Retail sales came out. We'll be talking more about that. That was a market mover, and we'll circle back to that. Tomorrow we've got housing starts. Jerome Powell will be speaking at 1:15 Eastern. On Wednesday, we've got the Fed Beige Book where they talk about the economy. Thursday, initial jobless claims, existing home sales, the Philly manufacturing number, and then a little bit of Fed speak on Friday. Kind of quiet, frankly. Last week's heat map, you see a whole lot of red. There was some green. Amazon, Google, Apple, Broadcom, NVIDIA, Costco, Walmart, Nike, they all did fine. But JP Morgan took it on the chin. Apparently, regulators are accusing them of helping to launder money for their wealthy clients. I don't know if they helped them. Maybe look the other way is probably more accurate. Either way, it's a problem for JP Morgan. Here is our 1-year heat map, a sea of green. Led, of course, by NVIDIA, up 238%. Microsoft, 46, Broadcom, 118, AMD 75, Alphabet 47, Meta 134, Amazon 82, Lilly 103%. So there's just been a ton of money to be made over the last year if you know how to pick stocks. So where are we at so far this year? The Dow's pretty flat year to date, up less than 1%. S&P it's come back down. Now it's at 7.4%. Still not bad for 3 months. The NASDAQ is up 7.8%. Bonds are down 2.6%. See, oil prices are up 19.3%. Market breadth, we like to look at new highs versus new lows. So for the week, 225 new highs on the NYSE compared to 94 new lows. On the NASDAQ, we had more new lows, 365, compared to new highs of 236. Markets have been relatively kind. We haven't had any big dips for like approaching 300 days. We haven't had a down move of more than 2%. It's been pretty awesome. Money's been moving out of large cap stocks here recently. And I suspect, mid cap and small cap has been getting a little more attention. The VIX is on the rise. This is the volatility index of the S&P 500 as measured by pricing for put options for downside protection. Retail sales popped. They're up 0.7% for March. So guess what happened? Interest rates started moving higher. Hence, the stock market started moving lower. So if you want to know what's going on with the stock market, keep an eye on the 10-year Treasury. The two of those are inversely correlated. So high sales means higher inflation, means the Fed's less likely to cut. I've got some probabilities for you before we're done. Profit margins for companies are expected to jump with time, you know, from June and then September this year, December flattens out, March, and then June of 25 even higher. So that's typically good for the stock market. Fast food inflation. Let me start by saying you shouldn't be eating fast food. Not only because it's not healthy, but people can't afford it anymore. Since 2014, the prices at McDonald's are up 100%. Now, I always kid about the prices at Starbucks are only up 39%. And inflation during this period of time is 31%. So if you want to go poison your family, take them to McDonald's. That's not literal, but I think we can all agree it's probably not the most nutritious, fat-free food you can buy for yourself or your loved ones. I just avoided a McDonald's lawsuit. You probably don't eat their prices. They're up triple what inflation has done. Popeyes, there's another stellar place for high quality food. Taco Bell, yeah, up 81% anyway. GDP winners, state by state. North Dakota, 5.9%, Washington, 4.8%, Wyoming, Nebraska, Kansas, Oklahoma, Texas, West Virginia, of all places, and Florida. They have thriving GDPs along with Alaska. Market sentiment. Notice it's starting to come back down a bit. So we've seen the bullish sentiment go from 43 to 50 to 47, back down to 43. We've seen the bearish tick up just a little bit, but the bullish is still higher than the historical average, which is 37. The bearish is still lower than historical average, which is 31. Fed probabilities. A month ago, there's a 72% chance that the Fed was going to cut in June. I've been telling you about this. Now it's down to 21%. Basically, it's off the table. And in July, there was a 90% probability. Now they're down to 47%. You know, this market, by and large, has moved up because of what it anticipated the Fed to do, and they flat got it wrong. Earnings season starting to kick off. We have Goldman Sachs today, Morgan Stanley tomorrow, some other banking stocks, United Airlines on Tuesday, CSX coming out on Wednesday, Netflix on Thursday, American Express on Friday. 1 year return sector by sector, big winners, communication and technology, followed by discretionary, industrials, financials, and a big drop off to materials, energy, healthcare REITs and staples have basically paid checking account returns, and utilities are down. Beware buying stocks solely based on a dividend. It's got to be the total return. All right, let's see what's going on in the charts. First with the SPX. Hadn't been a good day today, I can tell you, because those rising interest rates. So we're down about 1%. And the big news is we have crossed below our 50-day moving average. So if it holds there for a couple of days, that could prompt more selling. Be mindful of that. On the Qs, this is big tech. Also just crossed below its 50-day. And Russell 2000, it's been below the 50-day for a couple of days. So the charts do not lie. They are what they are. Right now, not quite as exciting as it has been. All right. Well, thanks for joining me once again. I will see you next week. Until then, be blessed and bye for now.